Hello, this is Alexander Green, Chief Investment Strategist with the Oxford Club, one of the nation's oldest financial think tanks. You know, we have a lot of members and they range from rank novices to the most experienced investors with decades in the financial markets. And I regularly get questions just asking me about what's happening in the economy or with interest rates or currencies or various stocks and bonds. And so I thought I'd take this time to just answer a couple of the questions that have come in recently. Now, my readers have seen a lot of challenges this year. We've had the coronavirus pandemic, we've got the upcoming election, we've had ongoing civil unrest, and the biggest economic contraction since the Great Depression. And many of them are asking, how can they maintain an optimistic outlook? Let me begin by saying that you have to remember that the national media delivers the world through a dark prism. You know, good things generally take time. They happen incrementally. In other words, it takes a long time to put up a building. Doesn't take much time at all to burn it down or blow it up, and that's what makes news. And so it's not the good things that are happening, the positive thing, it's the negative, it's the unusual things that are happening. And I say that because we can lose sight of the fact very easily that despite the pandemic and despite the economic contraction, that Americans are living longer than ever. Our standard of living has never been greater. Our educational attainment has never been higher. More people have a high school degree, some college diploma, PhD. Despite what you see on the evening news, violent crime is actually, even with what's happened recently, much lower than it has been in decades past. All forms of pollution, including greenhouse gases, are in decline. And carbon emissions are not declining worldwide, which is why they don't call it national warming, it's global warming. But lots of good things are happening. People are living longer, healthier, safer, richer, freer lives than ever before. And the reason I mention that is if you're going to risk your hard-earned money in the stock market, why, if we live in a horrible world at a terrible time and the country's going to hell in a handbasket, why would you risk your hard-earned money in the stock market? And you wouldn't. And so that's why I think it's important to actually know what's going on, the positive things that are happening that are not reported on the evening news. Now, I've had also quite a few readers who write in that they are brand new to investing and don't know how to get started. They want to know what is the best way to dip their toes into the investing pool. And I would say this, first of all, go open a discount brokerage account. Unlike years past, there are no minimums, there are no commissions. It's never been a better time to be a beginning investor. And you can do something simple like buying an S&P 500 index fund, or you can buy pieces of individual companies, which is different shares of companies like Apple and Amazon and Netflix and IBM and so forth. And even if you don't have enough money for a $3,000 share of Amazon, these discount brokers even cut them down. You can buy a $5 or a $25 share. Fractional shares are often called share slices. So that's a good way to get started. And you should also, of course, be reading my Oxford Communique, where I talk about what's happening in the world and the best ways to take advantage of various scenarios. Along similar lines, reader Gordon M. recently wrote in asking, what would be a good investment strategy for a beginner? Well, I actually wrote a book about it called The Gone Fishing Portfolio. It was a New York Times bestseller. And I essentially said that what you should do is own a diversified portfolio of index funds, large cap stocks, small cap stocks, foreign stocks, high grade bonds, high yield bonds, inflation adjusted treasuries, real estate investment trusts, gold shares. And that may sound complicated, but it's really not. And you can get a great deal of diversification and a perfect asset allocation by just following a basic asset allocation strategy. And I'd love to sit here and describe in detail how it's done, but you can check my book out of the library, The Gone Fishing Portfolio, or pick it out on Amazon, and or subscribing into the Oxford Club, where we have a white paper that condenses it all down, and it's a very easy way to get started. Reader Pam B. wrote to me that she's new to investing and trying to grasp the concepts. She's been doing some research, but she's still afraid that she doesn't know enough and will lose money. So how can new investors get over their stock market fears? Well, let me begin by saying that it's rational to be fearful about stocks, because while the long-term trend in the stock market is up, it does have some pretty bone-rattling drops from time to time. We certainly saw that in the first quarter of this year, and we saw it back in 2008 and 2009 and many times in the past. But here's what you have to keep in mind. People everywhere have economic needs, the chief among those being food, clothing, shelter, health care, Oxford Club subscriptions, and so on. And if you're going to have people with economic needs, the government doesn't build their houses and make their clothes and grow their food. It's corporations and marketers and transportation companies and utilities and healthcare companies and so on. And so you want to own a piece of those companies because over time, the successful companies, their sales will rise, their earnings, which is their profits, will rise, and the share price will rise to reflect the fact that business is getting better. So yes, you should be nervous about the fact that the market will drop from time to time. That's perfectly natural as long as you don't react and sell when the market drops. Because if all you did was sell every time the market dropped, you'd regret it. In fact, you can look back at a chart of 200 years of stock market history and all those jagged drops. It's perfectly obvious in hindsight that they were buying opportunities. So please keep some cash set aside, expect the market to make a precipitous drop from time to time, and then put that cash to work to buy some great companies cheap. Kathy L. wrote in asking how investors should protect what they have, asking about gold, Bitcoin, etc. Well, let me say, first of all, you're not going to protect what you have with Bitcoin. You might make some money, it could be a worthwhile speculation, but that is not a safe haven for money. Of course, most safe havens these days don't pay much of anything. Even a 10-year treasury bond pays 0.5%, and most money market accounts pay nothing. So you've got to stick your neck out and take a little bit of risk somewhere, as long as it's not money you need in the very short term. Obviously, if you're going to spend that money on college tuition in the next couple of years or make a down payment on a house, that's money that doesn't belong in the stock market. But for people looking out further, there is nothing over time that's outperformed a diversified portfolio of common stocks, or better yet, uncommonly good stocks. Gold hasn't kept up, cyber currencies haven't kept up, real estate, commodities, nothing, bonds, bills, what have you, none of them have beaten a diversified portfolio of common stocks. So that's what you should be doing, owning lots of business, diversified, so if you have trouble in one area, it doesn't affect the whole portfolio. Now, once investors have begun building their portfolios, many of them struggle to balance their investments and diversify. Many readers have written in asking how they can maintain the right balance in their portfolios. Well, that is to a certain extent a personal question. If you're young, quite frankly, you should be almost fully invested in stocks, knowing that if the best thing that could possibly happen to you would be the market would go down, because then you could buy even more shares at a lower price. But as you get older and you feel like you should be more concerned about the safety of your principal, you're going to want to own more in bonds or some in cash and diversify into safer investments. And there is no one-size-fits-all risk tolerance. If young people have long time horizons and they should be willing to withstand more volatility. Older people obviously have less long time horizons and don't want to see as much volatility, because if you're retired, for instance, and all your money's in stock and you're drawing the money down to pay your overhead, obviously a bear market means you're pulling money out at the bottom, and so you don't want to do that. If you're retired, set some money aside to cover a couple of years' expenses, keep the rest invested, and in the good times you can cash in some stocks and pay your bills, and in the bad times you leave your stocks alone and draw down your cash and bonds. Finally, Paul C. wrote in that he feels overwhelmed with information, and Noreen Z. asked how she should know who to trust. They want to know how to determine whose advice to follow and how to balance different strategists' advice. Well, as far as there being so many choices, there's an old saying that you can't kiss all the pretty girls, and that's true when it comes to investing too. There are a lot of great ideas out there. But Warren Buffett, who's the most successful investor of our era, said you ought to act as if you have a punch card with 20 punches in it, and not buy anything unless you're willing to use one of those 20 punches to buy it. That's what keeps you from over-diversifying. Now, I know that I find a lot of investment ideas, and so do my colleagues. They're always writing something up, but again, you can't kiss all the pretty girls. You've got to limit it to the best of the best. And Peter Lynch, who's the most successful mutual fund manager of all time, says if you own 20 stocks and you have a new stock that you absolutely have to buy, what you have to do is sell your number 20 stock. In other words, keep your winners But if something's lagging or falling behind or going in the wrong direction, that's what you cull from the portfolio and use that money to pick up something new. And so I would encourage you not to over diversify, because remember, there's only 30 stocks in the Dow. So if you own 50 or 100 stocks, you're probably over diversified. And all the great fortunes have been built not by diversification, but by concentration. In other words, Jeff Bezos isn't the world's richest man because he's spread his money out so far beyond Amazon, or Bill Gates beyond Microsoft. Their fortunes were built on owning great companies in large quantities. And I'm not suggesting you plunk all your money in one stock, but I am saying that to plunk your money into hundreds of stocks means that you might as well own an S&P 500 index fund, which is not a bad idea, but you're not going to beat the market if you own the market. So anyway, that's it for today. I'm going to be answering more questions in the future. I encourage you to read Liberty Through Wealth, or to subscribe to my investment letter, the Oxford Communiqué, where I'm talking about what's happening in the world and why it's happening and what you should do with your money today, every week. So thanks for joining me, and I look forward to talking to you again soon.